Hello and welcome to another episode of Investment Take-Ons, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining us is Manuj Jain. He's Head of Product and Strategies at WhiteOak Capital AMC. Welcome, Manuj.
Thank you so much.
Good to have you back with us. Now, your column in Wealth Insight December 2024 issue, never mind FII selling. You mentioned that India's share of global market capitalization has nearly doubled over the last decade. What are the main factors behind this growth? And how does it change India's role in global investing?
So see, over the last 10 years, we have seen various structural reform in India. And all our macros, be it inflation, be it GDP growth, or be it, let's say, debt level at a country level, at a debt level, our current account deficit number are pretty much stable as compared to many of the emerging markets which are facing a lot of trouble. In fact, not only emerging market, during last 10 years, we have seen trouble in many developed countries also. So that is now started to reflect in the confidence given by investment community towards India. So you forget about the recent outflow by the FIIs, but otherwise, there is a increased belief that India is a more stable country. And when your current account deficit is in check and your inflation is in control, your currency is also in relatively is better place as compared to many of the emerging market. And that has started to reflect in the numbers. So like we mentioned that about few years back, India's weight in global market cap used to be about 2.2%. Right now it is about 4.3 or 4.4%. So it has doubled. Not because India did well. Globally, let's say US also did well. But India did better than most of the other country. If you remove USA from the picture, let's say you are a US investor, you are a US FII. So you are looking to invest beyond USA. So if you remove USA from global market cap, because USA is the largest portion. So ex-USA, India's weight in global market cap is about 8.5 to 9%. Now think about it. What does it mean? If you are a foreign investor looking to invest outside USA, now you cannot ignore India, which has about 8-9% weightage. It is like you are an active fund manager investing in India and you are ready to ignore HDFC. Hypothetically, let's take example HDFC, which has 9 to 10% weightage in the index. It is very difficult. If you take that call and if you go wrong, you can underperform for many years. So it is very difficult for FIIs to ignore India, which has about 8-9% weightage ex-USA or about 4.3% weightage including USA. It is almost impossible. You have to take a call whether you want to be overweight in India or underweight on India or neutral weight. You cannot go zero. If you are going zero, you are risking your whole performance. Your performance can be, maybe you will be in top quartile or you will be at bottom quartile, which typically people don't do. So yes, because of the stable macro condition in India over the last 10 years, global investors' belief in India has increased. That is also reflecting in our equity market performance, and hence our share is now doubled as compared to a few years back, and that means that it is very difficult for global investor to ignore India.
So now the next question is that, like you mentioned, India's weight in MSCI Emerging Market Index has nearly doubled over the last decade. So what does this mean for investors both globally as well as domestically?
So see, India's weight in MSCI Emerging Market Index, which is a very popular index. So for our viewers, let me give you some background. So typically it is an index which is an amalgamation of various emerging markets, including India or let's say some other emerging market like Taiwan, Indonesia, etc., etc. And it is being followed by many of the global investors as well. So if you are a global investor looking to invest outside USA, for example, and you want to invest in emerging market because you believe that emerging market can grow even faster than your home country. So usually FIIs do not cherry pick countries that I want to invest in Indonesia or Taiwan. They typically invest in basket. So MSCI Emerging Market is a basket of all the emerging market or most of the emerging market. So instead of cherry picking any particular country, they invest in basket. So hence this index is very important to track. India's weight in MSCI Emerging Market used to be about 8% 4-5 years back. Today it is about 19% as we speak. So which means, let's say earlier when FII used to invest, let's say $100 billion in an emerging market, we used to get $8 billion because our weight was 8%. Now today, if they invest same $100 billion, we will get $19 billion because our weight is now 19%. Now think about it, that earlier we used to get $8 billion in this example. So we used to see whenever FIs were buyer, we see market doing well. Now if they invest 100, we will get $19 billion. You and I cannot even imagine to what level market will be at that point of time. Now when they will invest, I don't have any answer, because that depends on various factors, what is happening globally, what is happening locally. But as and when they come back, and they have to come back, like I mentioned, they have no choice. So we will get lion shares this time.
Okay. All right. Now in your column, you also said that 75% of FII investments, they come from non-dedicated routes, like global emerging fund, market funds. So can you explain what does this mean in simple terms, first of all, and what risks or opportunities does this create for Indian markets?
So let's first decode what is non-dedicated and dedicated.
Right.
So if you are an FII, you decided I will invest my money only in India. Okay, bulk of my emerging market money will go to India only. So that is called India dedicated fund. That your funds are directed towards one particular country. You are dedicating your fund to India. Versus non-dedicated means you took a call that I want to invest in emerging market. I have $100 billion.
So like you mentioned, picking up baskets.
So 75% of the money that India receive from non-dedicated fund. So it is not cherry picking India. It is about they have invested in emerging market basket, and we got some money based on what is our weight in that basket. So it also means when FIs are redeeming money from India, they may not be redeeming only from
India. There, okay.
Because 75% money, if coming from basket, it will go via basket only.
Okay.
Which means they must have redeemed $100 billion, and because India has certain weight, they must have redeemed $100 billion from emerging market, and because India has certain weight in emerging market, our country will also see outflow. Right. So many a times when we see that FIs have withdrawn so much money and we worry that they are seeing some problem in India, it is not an India-centric problem. They are withdrawing money from emerging market. Now why they are withdrawing money from emerging market? Let me give you an example. During 2022, there was Russia-Ukraine war going on. So, and also crude oil prices went up, which is very negative for most of the emerging market, because their fundamentals, so their macros are not so strong that they can handle such kind of shocks, supply chain issues and crude oil, because most of the emerging markets are net importer of crude oil. Crude oil prices going up is very negative for their overall current account balance and inflation, etc. But India did very well. Despite this thing, we also saw some outflow from FIs. It is not because they want to redeem from India. In fact, India dedicated funds were seeing inflow, but because they are very small. So in that context, we have to understand that whenever there is outflow happening from FIs, it may or may not be India-centric problem. If it is an India-centric problem, then we have to think differently. But if it is because they want to take a bet on US election, and hence they want to divert their flow from emerging market to USA. So now this is not an India-centric problem. Today our macros are very strong. Our rupee currency is stable. Our current account deficit numbers are very controlled. Our inflations are controlled. So they are not redeeming because they are seeing some problem because they see opportunity in USA right now. So yeah, this is how you should look at it. That money, if coming via basket, will go via basket. We may have very good fundamentals, but because of some global event, we can also see outflow.
Okay, and what risk or opportunity does this present for Indian market?
So risk is that any global event which can trigger risk off from emerging market. So investing in emerging market is basically you are taking slightly higher risk from the FIS perspective, because emerging markets are slightly more volatile as compared to developed market.
Right.
So whenever there is a risk off from emerging market, you will also see outflow. Because money is coming via basket, most of the money. It is not coming to dedicated to India. And the opportunity is, like I mentioned today, our weight in that basket, one of the indexes, let's say emerging market, is 19%, which used to be 8%. Whenever there is a risk on, and FIIs will come back to emerging market. Earlier we used to get only 8 rupees, today we'll get 19 rupees. DIIs are already positive on India. I mean, they are incrementally biased in India, DIIs. So imagine with one party selling right now, the FIIs are continuously seller, and only one party is buyer, which is DII. We are where we are right now in terms of market. We did well, by the way. Even today, our YTD calendar year return is very healthy, double-digit healthy return. Now imagine if both the parties are buyer, where will market be?
Right.
So this is the opportunity.
Okay. Now, India's demographic, the young population and digital transformation, these are often seen as big strengths that we have. So how do these trends translate into real opportunities for equity investors?
So what has happened in last 4-5 years is that buying, let's say, mutual fund, or let's say equity also via some stockbroker, is very easy now.
Yeah.
You can sit in your home, you can buy at a click of a button. Everything is digitally possible, and everybody now has smartphone in good internet connection, and without even signing on paper, you can do transaction.
Right.
So that has helped in increasing the penetration. Second, the awareness, the whole campaign by, let's say, regulator, this mutual fund sahi hai, and social media platform has given so much content today. There's ample content available, like what we are doing also, but there are many people are making efforts to create financial literacy, and the amount of financial literacy has gone up tremendously, exponentially in last 4-5 years. So all these factors, that investor awareness is increasing, maybe because of the good content and maybe because of the efforts by regulators also, and buying is very easy, making transaction is very easy digitally. All this is helping new investors to participate in the market. That also means if there are a lot of investors showing interest, it should create some kind of stability. Stability doesn't mean that, as we mentioned, that it doesn't mean that market cannot fall by 10-20%, but as compared to what it used to be 10 years back, there will be great amount of stability in the market.
Right. Now, last question. If we were to revisit this conversation 10 years from now, what do you think would surprise us most about India's journey in the global markets?
Okay, so see, in last 10 years, as we mentioned in our column itself, that FII's share in Indian market has reduced from 22.5% to right now less than 18%. But that graph will give you an indication that FIIs are net seller in the market, and hence their share has reduced. It is not true. During the last 10 years, also FIIs are net buyer in India. But because DIIs are outshining them, DIIs are even more positive in terms of flows, and hence DII share has increased. It is because of DII is buying, FI is buying has been overshadowed. So I strongly believe, and I want to see that after 10 years, DII's share will be much higher as compared to FI. That we are already seeing, like 10 years back, DII's share in Indian equity market used to be only 10%, and FI used to be 22.5%. Today, both are at 18%. I am of the opinion that over the next few years, the kind of trend we are seeing, although we are extrapolating, we have this recency bias also, but I want to believe this thing that over the next 10 years, DIIs will outshine in terms of their contribution to the Indian equity market, and our dependence on FIIs will further go down.
All right, on that positive note, let's wrap up today's conversation. Thank you, Manuj, for joining us. Thank you for the insights.
Thank you so much, Rishi, for calling me.
Thanks.